Hello and welcome to this fortnightly market outlook video. I am Devash from Retail Research Department. Today, I will start the session with the key developments in the global markets and how indices have fared over the last 1 month and last fortnight. After me, my colleague Nagraj will share market outlook from technical perspective, and after that, Nandish will share data and insights from derivative markets. In the end, we will try to draw some conclusions. So key international development is that the after 3 week losing streak, this week Nasdaq and S&P 500 ended the week on a positive note because the annual hourly wage growth came in little lower than expectation. That has enthused the market because it has potentially eased inflationary pressures. Next week, it is important to look at the Tokyo's inflation number, which will be released on Tuesday. We know that the Bank of Japan last month surprised the market. Chinese markets are doing quite well, as reports are there that they would reopen the border with mainland China. So January is usually a very crucial month for US market. Historically, the January market's performance had been a strong indicator on what is going to be happening for the rest of the year. In fact, 71% of the time it has a good correlation with what happens during the year. That is because the fourth quarter earnings will start coming in from the next week, and during the January month, most of the earnings will come out. And as earnings pan out, the markets perform, and that is usually a good indicator. So be watchful of the quarterly earnings seasons, which is starting from next week. Now let's survey what is happening in important asset classes. First, the dollar. This is a chart of the dollar index, and many of you remember that we said that it is peaking out between 113 and 115 levels, and now it has corrected to 103, and it is threatening to break this level. And if it breaks this 103 104 level, then it will be a good news for equity markets around the world. Let's look at the our currency. So our currency has more or less topped out around 83, and last week it has appreciated back to 82.2 level. This shows that there is a strong supply of dollars around 83 level. Let's look at the international markets, the mother of all market, the US S&P market. It is continuing to have lower top, lower bottom, and it is in a downtrend. Though for last couple of weeks it has found support near 3800, and so we have already covered that it bottomed out around 3500 levels in mid-October. It where the rally lasted till 4100 levels, and after the brief correction, it is consolidating near the 3800 levels. Nasdaq is comparatively quite weak. Over the last few weeks, it is trying to find support near this between 10,000 and 10,400 level, but still the downtrend of lower top and lower bottom is continuing. Above this 11,500 600 range, it will turn bullish. Compared to American markets, the European markets are actually showing the sign of life and they are coming back strongly. The German market has strongly rebounded from 12,000 levels and now trading near 14,600. The UK market surprisingly is also on the verge of a breakout and it is going into the all-time high territories. So UK, France, Germany, all these markets are contrary to general narrative, they are doing quite well. The commodities also have started to show signs of breaking out. Copper is again back to almost 4 level and above 4 as we have discussed in the past videos. It has a room to run up to 4.5 levels also. Crude oil is still in the downturn and last week it has corrected from 88 level to back to 78 level. Quite significant fall we have seen in last week. Almost $10 per barrel correction has happened in the crude oil, and which is a very good news for an energy importer like India. Bitcoin has lost most of the trading interest and it is consolidating near its recent lows. Now let's turn our attention to the indices. So as you can see, American markets have a divergent movement. Dow is almost flat for the month, while Nasdaq has corrected by 4%. On the one side, European markets are doing quite well. Hong Kong is doing quite well on back of China opening. Same is the case with the fortnightly performance. So European markets are doing quite well. Chinese markets have been surging. Other markets are more or less steady. For India, the benchmark indices like the Sensex and Nifty are flat, but Mid cap and small cap are showing signs of coming back. They are up by 5%. What are the sectors which are doing well? So metals are the outperformer. Metal and oil and gas, all these commodity stocks have shown good outperformance in last fortnight. The IT and healthcare sector is actually underperforming. We need to pay an attention to IT companies as they are going to come out with results, especially the bellwether IT companies like TCS, Infosys, Wipro. They will start reporting their quarterly results soon. And once the result related volatility is out of the way, these companies are looking attractive from a longer term perspective. On economic calendar front, on 12th of January, we will see the IIP and CPI from India. On 13th of January, important data from China will come out. And on 18th January, the Bank of Japan policy decision will come out, which is very important. Right, so this is about the economic calendar. Now, let me invite my colleague Nagraj to share insights from technical analysis perspective. Over to you, Nagraj.
Hi, this is Nagaraj Shetty, one of the technical research analysts at HDFC Securities. Today, we are going to discuss about the fortnightly market outlook as per the technicals. Without wasting any time, I'll bring you the slides of the daily movement. On the daily time frame, yesterday market has witnessed continued its downtrend, which is a downtrend continuation pattern over the last three sessions, and we can see, friends, from the chart that Nifty has reacted from the strong resistance of around 18,250 265 levels and currently placed at the support of swing low around 17,780. As of yesterday, there is no kind of any reversal pattern unfolding on the daily chart. On the weekly chart, we expect the moment. Last 3 weeks, market has been moving ups and downs, and previous week we have seen a down moment, after that up moment, and this week we have seen a down moment. It is a completion of a pullback rally as per the weekly time frame after the downside breakout of the support around 18,250 levels. A few weeks back, the market has validated this downside breakout after showing a pullback rally towards 18,250 265 levels, and now placed at the edge of moving below the immediate supports, which is 17,800 levels, which are 20-week EMA and also the lows of the last 3 weeks. So any pullback rally from this support could be a sell on rise opportunity. Friends, on the monthly time frame, last week we observed that this indication suggests that there is a formation of a bearish engulfing pattern, which is significant as per the long-term charts. Bearish engulfing or a bearish dark cloud cover pattern on the monthly chart indicates that broader market picture is negative, and we are likely to see a further declines, and the downtrend is continuing. The long-term support of downtrend line is coming. This support of downtrend line is coming around 17,200 to 17,000 levels. As per the long-term charts, these lines are going to be a good support for the market during the market corrections. And in the mid cap and small cap segments, they have displayed strength compared to benchmark index, having reacted from near the key overhead resistance. These lines and these NSE mid cap and small cap sectors have reacted minorly in the last week, and there is a possibility of further consolidation or weakness in the coming week after a small pullback rally. It's time to book profit or lighten the long positions in mid and small cap segments in the portfolios during pullback rallies. Otherwise, advised to place a strict stop loss on the trading positions. So, friends, long-term charts like a quarterly, half-yearly, and yearly indicates the primary trend of the market is intact. What is being seen in the quarterly chart is Nifty is placed around the breakout of 18,500 600 levels. This internal correction is going to be a buy and dips opportunity as per long-term charts. Like half yearly showing a broader ring movement of 15,500 to 18,500 levels, and yearly charts, what we can observe over here that in the last year 2021 we have seen the formation of consolidation pattern, and historically previously such patterns have eventually led to uptrend continuations in the preceding years. So the consolidation moment, what has happened, and what is the downward correction, what is happening in the smaller charts are going to be a buy and dips opportunity. And so the conclusion is the market reversed down from the hurdle of 250, 18,250 levels and continued its weakness in this week. Nifty is now placed at the edge of the support of around 17,800 to 17,750 levels, and minor pullback rally can't be ruled out from near the support before showing a decisive downside breakout of the support. On the move below the supports, the weakness could be intensified, and the next supports to be watched is around the 17,450 levels, which could be achieved very soon, which is the 200-day EMA and the 38.2% Fibonacci retracement as per the taken from the June bottom to December top. If the Nifty moves below the 17,450 400 levels, the next lower support to be watched is around 17,000, which is the 50% Fibonacci retracement. So hereby advised to book profit of longs in any pullback rally in the by next week, and one may place a stop loss in trading long positions. Thank you, friend. That's all from my side.
Thank you, Nagraj. Now let's go to Nandish. Over to you, Nandish.
Good morning, friends. I am Nandish Shah, derivative and technical analyst at HDFC Securities. Today, I am going to discuss how the market is looking from the derivative side. So let's straight away jump to the presentation. Short buildup is seen in the Nifty future during the last week, where we have seen 11% rise in the open interest, with Nifty falling by 1.36%. Similar trend is seen in the Bank Nifty future also, where we have seen short buildup, where open interest has risen by 13%, with Bank Nifty falling by 1.86%. Now coming to option data, Nifty open interest put call ratio fell sharply to 0.75 levels on Friday from 0.97 levels on Thursday. Among the weekly options, that is on 12 January expiry, aggressive call rating is seen at 18,000 to 18,200 levels, indicating 18,200 level to act as a strong resistance going forward. On the other hand, Nifty is likely to find an immediate support around 17,800 levels, where puts have been written. So as you can see in this option distribution chart, we have seen massive call rating at 18,000 and 18,200 levels. And on the downside, we have seen some put rating at 17,800 level, which might act as a support going forward. Now coming to FIs, aggressive short buildup is seen by FIs in the index future segment during the January series till now, where they have net sold worth rupees 3891 crore in the index future, with their open interest going up by 38,000 contracts. And that's why FI's net long to short ratio in the index future has fallen to 0.70 levels on Friday as against 1.31 levels at which we had started January 2023 series. This indicates that FIs are net short in the index future segment. As you can see in this graph, FI's long to short ratio in index future was 1.31 levels in the beginning of the series. It has now fallen to 0.70 levels. It indicates that FIs are net short in the index future. So coming to the outlook, as we discussed earlier, short buildup in the Nifty futures, fall in the put call ratio on the back of aggressive call rating at 18,000 to 18,200 levels, short buildup by the FIs in the index future segment, FIs long to short ratio below 1, which indicates that they are net short in the index futures, and buildup of bearish positions in the index future segment by them, where they net bought 2,25,000 contracts of put as compared to 35,000 contracts of call in the index option till now in the January series. This all indicators indicates that one should remain cautious for the market for the coming days. Therefore, our advice is to remain bearish and use any sharp pullback rally on the back of strong global cues to reduce long positions and also create short positions with stop loss of 18,200 levels. On the downside, 17,800 level to act as an immediate support where puts have been written. Technically also 17,800 is a very strong support. So any close below 17,800 level would result into further long unwinding, which might push Nifty to even 17,500 levels. Now coming to Bank Nifty, we have seen short buildup in the Bank Nifty futures also during the week, call lighting at 43,000 and 43,500 levels, and also short buildup by the FIs in the index future segment indicates that one should remain cautious for the Bank Nifty also. Therefore, our advice is to remain bearish and use any sharp pullback rally on the back of strong global cues to create short positions with stop loss of 43,500 levels. On the lower side, 41,500 to 41,800 level to act as an immediate support where we have seen put writing. Any close below 41,500 level would result into sharp long unwinding, which might push Bank Nifty to 40,500 to 41,000 levels in the coming weeks.
Okay, now let's conclude. So as we have seen, the US markets are still in a small range. European markets are turning bullish. Emerging markets are rebounding as expected. We remain cautious on the benchmark indices. 18,200 in Nifty and 43,500 in Bank Nifty are key resistances. We will turn bullish above these levels only. Compared to the benchmark indices, we feel mid cap and small caps are better placed, especially metal stocks are outperforming. Result season, quarterly result season is about to start, and it is important to pay attention to these results. That's all for this video. We hope you like this video and find the information provided useful. If you have any comments or suggestion, do reach out to us. Thank you.